Okay, the recording has started, I believe. So what we're gonna do today is I have some slides I'm gonna go through. And then after that, I will open the floor to some questions and hopefully we will kind of be able to fit this between like 45 minutes and an hour in total. So, I'm just gonna share my screen now. Um, okay. I need to present this actually. Um, could someone just let me know if they can see the slides? Okay, amazing. Um, so yeah, what we're going to be talking about today is financial regulations and fixing broken markets. I studied economics. I have worked in uh, sort of investment management. So this is a topic I am pretty familiar with. So yeah, just in terms of an overview, we're gonna just sort of have like an introduction to some of the things we're talking about, and then we'll talk about some classic market inefficiencies and failures, and then different goals and types of regulations. And there's also going to be some case studies throughout. So, just starting off, in the most broad sense, a market failure occurs when resources aren't allocated efficiently, basically. So, that could mean that there aren't enough resources to go around. There are people who want a good that aren't able to get it, or want a service that aren't able to get it. Or it could mean that there is someone who is willing to pay for something at a certain price, and there's someone who's willing to sell that thing at that price, but they're not able to find each other within the market. Um, there's many different like broken markets or market failures that you might have heard of. There's asset bubbles, which is when prices kind of rise beyond what's justifiable based on the fundamental value of the thing. So you might have heard of the housing bubble in the US, the dot-com bubble in the early 2000s, the Japanese stock market bubble in the 1980s. I will sort of flag that this one's a little bit controversial because now we kind of live in an era where many stocks valuation is not really based on the fundamentals, like Tesla, Uber, classic examples. Um, so there's a bit of a caveat there. The next is price gouging, which I'm sure, again, many of you have heard of. It's basically when demand for something is very inelastic, so people are willing to pay a very high price, and then thusly prices get very, very high. So, healthcare in the United States is an example of this in some cases. Early during COVID, when there was like um, a lot of demand for like PPE, I think it's called, or like I think toilet paper was the thing in North America. You saw a little bit of this. There's negative externalities, which is byproducts such as pollution or like secondhand smoke. Any environmental damage, climate change is sort of the classic one that we think of that's not priced into the good. And then we also have allocative or productive inefficiency, which is where resources aren't allocated where they're most efficient. So, like building a factory where there's no workers. If you ever have debates about like, should we do X infrastructure project or like X industrial policy, or should we do Y thing, or like, should we give people cash transfers or should we give people, like money that they can only spend at the grocery store? The question of allocative or productive efficiency comes up. Or, should we build public social housing in one place versus another? These are debates where there are large questions on allocative efficiency. There's monopolies, which I'm sure you guys are all, again, quite familiar with, just uncompetitive industries. And then there's monopsonies. A monopsony is basically a monopoly, but for labor. So where there's only one company that's doing the hiring in a given area. And then there's also more, but I think this broadly covers the vast majority of like broken or inefficient markets that we might see in the real world and especially in debating. Um, there's sort of three classic market problems that people talk about a lot. If you ever take like an economics class and on like public markets or the financial system or banking, you'll probably see these three come up. The first is moral hazard, which is basically when people have incentives to take on risks because the downside falls on a third party. So there's the classic example of the 2008 financial crisis where a lot of banks thought they were too big to fail, i.e., if they collapsed, it would be so detrimental for the US economy that they were quite certain that the government was going to bail them out. And that incentivized them to take on lots of risk because the government was going to be the one that cleaned up their mess at the end of the day rather than the bank themselves. This is also the reason why, for example, like loans have collateral because otherwise there might be little incentive to pay them back. The second is the asymmetric information problem, which leads to adverse selection, which occurs when one party basically takes advantage of asymmetric information that exists. So, this can cause something called crowding out of good lenders or good borrowers as well, which is basically imagine a world where like there was no credit scores, or where there was no centralized way to learn the credibility of someone you were going to lend money to. There would be only the person that was taking out the loan would know whether they were going to pay it back or not, or would know whether they're a reliable person. And this obviously makes lending money very risky, and thusly interest rates get a lot higher. But at these very high interest rates, good borrowers who are responsible, who plan to pay their loans back, are going to be discouraged from seeking out those loans because of how costly they are. So asymmetric information's problem cause adverse selection, which basically pushes good borrowers out of the market. The classic example of this, as well as the lemon problem, which is selling used cars. If you are interested in this further, I recommend you look that one up. And then the third we have is principal agent problems, which is somewhat similar to moral hazard, and it's where someone appoints a proxy or someone to act on their behalf, but the incentives of those two people are not necessarily aligned. So one of the classic examples you'll see of this a lot is financial advisors that basically like help people prepare for retirement or manage individual people's stock portfolios, that make money on trades and how many trades they do versus on the net performance, because then they might have an incentive to like buy and sell the same stock 5 times because they generate money on each of those trades, even though that would be bad for the end user. Employment contracts are a good example of this as well. People typically get their bonuses annually, whereas companies might have like 30-year horizons that they care about. So employees might be incentivized to sacrifice the short term for the long term, things like that. In terms of what some mechanisms for addressing the failures that we've talked about are, the first that I'm sure you are familiar with is antitrust, which is breaking up large companies or just blocking mergers in the first place. This has sort of two benefits. The first is increasing competition generally, and the things that, oh, am I echoing anymore? Okay, no. Yeah, increasing competition generally and the benefits that can flow from that in terms of lower prices, better innovation, sometimes better customer service is also an advantage of this, and also can reduce risk. So if one firm is responsible for basically the whole industry of something, like a classic example, or I think a very good one, is in Canada, the telecommunications industry is very, very monopolistic. There's basically two big companies, and then depending on which part of the country you're in, there might be like a smaller third one. And prices are very high, but also there's a lot of risk associated with this. A few years ago, there's one of the big providers is called Rogers, and Rogers had an outage, and literally people did not have any internet connectivity, like cell phone service, couldn't call 911. Businesses, major Canadian banks like couldn't operate because of the outage of Rogers. So there's also systemic risk that's introduced when one firm controls a large amount of the market for something. And that can be reduced by implementing antitrust. Different jurisdictions have different standards. To my understanding, North America, especially Canada, quite relaxed on antitrust, and there's a very high bar that has to be met. Whereas Europe uses a little bit of a lower bar for when they decide to follow through on antitrust proceedings. And breaking up companies is not always straightforward, especially when it comes to what's called a natural monopoly. And this is basically an industry where it is most efficient when it's monopolistic. This is usually because there's very high startup or upfront costs. So telecommunications, which I just talked about, is a good example of this. It's very expensive to build cell towers. I think railway or like railroads are also a prominent example of this. And that's often when you'll see governments turn to something like regulation rather than antitrust or breaking up companies. And then there's the other half of this, which is just being able to block mergers, which obviously gives the government a lot of power. Because, if you are trying to merge with two companies and you want your merger to be approved by the state, corrupt states can use like quid pro quos. You'll see this happening in the United States right now with Paramount is trying to buy another firm that I don't off the top of my head remember the name of. I was reading an article about this an hour ago, but basically, the Paramount is being sued by Donald Trump over a segment that appeared on 60 Minutes, which is like a cable news show that they have. And they agreed to settle the lawsuit because they want the Trump administration to approve their merger. And because of this, programming, including the Colbert Report, which is like a big late night show here that covers politics a lot, has been canceled. So you'll see some of this quid pro quo kind of politicking coming up as well. The second is just increasing information in the markets and aligning incentives. So this can look like disclosure requirements. So like your bank would have to force or would be forced to tell you if they stood to make money off you buying a certain stock. Um, that is part of what a disclosure requirement can look like. It could also look like disclosing different conflicts of interest, things of that nature. The second is performance-based pay. So, doing something like giving employees shares in a company's stock or giving them some ownership stake so they have more incentive to care about the long term versus just like an annual bonus where they care about the short term. Collecting collateral on loans or using credit scores, which sort of combine information based on someone's history and then indicate how good of a candidate they are to receive a loan. So these are all different things that exist to just sort of fix the problems we've talked about. General objectives of most market regulations, I think, fit under five categories broadly. The first is accurate pricing, which is the idea that the price of stock should be reflective of how much a company is actually worth, or the price of any asset. Bubbles generally undesirable because they will one day pop and then people will lose a lot of money. Um, so, for example, I think when GameStop stock was going through the roof, there was some discussion of whether I think SEC would like tell Robinhood that they had to cease the trades because there was a bubble that was forming. Um, and then the idea of stability as well. You don't want prices or your currency either as a state to vary a ton. Stability is generally quite desirable. This is, one of the things the Fed tries to do is by lowering inflation, they are inherently trying to keep prices stable. There's productivity, so you want productive companies to succeed and unproductive ones to fail. So often you'll see policies that sort of target that by either offering like tax breaks or subsidies for companies that want to reinvest in productive technology or want to hire the best workers, things like visa programs that support bringing in very productive people from other countries. Um, Obviously, profits, want to protect firms' viability, and then welfare. So we want money to be distributed in a way that's most productive and most well disturbed. Well, not well disturbed, well deserved. The next thing I want to talk about is risk. So risk is basically the probability that actual outcomes can differ from expected ones, and this can obviously be a source of profit or a source of loss. There's a lot of different types of risk. I've just included a few here. There's credit risk, which is risk that a borrower will default. There's liquidity risks. There's risk that an asset can't be sold. There's systemic risk, which is risk, pardon me, that an individual failure can spread. And this is through something called contagion. A little case study here. In 2008, the first few banks to have defaults on the mortgages they owned became insolvent. So they owed more money than they actually had. And then, in order to meet those liabilities, they needed to sell off their assets. So, in order to pay out their debts, they needed to sell the things that they held on their balance sheets. So, this flooded the market with a bunch of different types of securities, which drove the prices on those securities down. And then, because market supply increased, but there was no commensurate increase in demand, other banks that had those same assets on their balance sheets were like, oh no, this thing that we used to have that was worth $100 is now the market value of it is only $70. So we are now insolvent too because our balance sheet has gone way down in value. And then we need to sell off our assets too to meet our liabilities. And that is how contagion works, basically. So that's systemic risk, which is how the interconnectedness in financial markets means that one failure can cause a lot of other failures. Um, there's the importance of risk as well in terms of regulations. So the first thing that we care about is incentives. You want to reduce things like moral hazard. The second is hidden risks that are often tried to regulate away in terms of some of the disclosure requirements we talked about earlier. Requirements on due diligence that you need to do on acquisitions to sort of make sure that the quality of what you're buying is accurate to how it's priced. This is why also things like rating agencies exist. And the more complicated security is, the more easier it is to obscure the risk. So mortgage-backed securities, prior to 2008, if you ever seen The Big Short, there's a really good explanation of this. But basically, these were, and also collateralized debt obligations were very, very complex financial instruments. And because of the complexity, it was easy to hide that they were basically based on very poor quality mortgages that were unlikely to ever be paid back. We also want to do things like mitigate contagion and also engage in risk sharing. So ensure that companies hedge, that they disperse risk against many different parties, etc. Just give me 1 second before we move on to this. So, in terms of other measures that exist, there's things like deposit insurance, government securitization, and balance sheet requirements. The first is that, especially 2008, there's been massive increases on the limits on risk taking that have been imposed on banks that do mostly commercial banking. Shadow banks, which operate in most countries, um, are basically banks that don't take deposits from people. So, for example, like um, uh, I'm pretty sure like Morgan Stanley, example of a shadow bank, Goldman Sachs, kind of a shadow bank as well, and that they don't really take, you wouldn't have like a checking account with these banks. Um, so commercial banks that do a mix of like financial services, but also consumer banking are subject to stress testing, where basically they will be audited by regulators, and they will have to show that if there was some sort of financial crisis, so if the value of the assets they held like massively went down, or if there was a massive amount of withdrawals from their bank, that they would still be able to withstand that. So this is basically a computer simulation that gets run based on what a bank's balance sheet looks like. So all the money they owe and all the money they have, or all the assets they have. There's also capital requirements. There's been the Basel Accords, which were implemented after 2008. We're reaching the final stage. There was Basel 1, 2, 3, and now we're in Endgame. And these basically have very stringent regulations on the types of assets banks are allowed to hold. And these are somewhat technical. I'll try to provide like a high level explanation, but to my understanding, basically how this works is there are different types of securities that are assigned a different number or like a different score based on how risky they are. And then they get multiplied by that score. And then there is a total score that banks have, and then they have to be within the limits of risk, basically. So like they can only hold a certain amount of very risky assets. Different assets have different weightings, and they must be within the rules set out by Basel 3 or Basel Endgame. This has been widely adopted in many, many countries. I think most of Europe, North America, parts of Asia and Africa as well have all adopted the Basel Accords. There's also fail safes that exist. So the two big ones that we can point to is deposit insurance. Most countries will have some form of deposit insurance that protects consumers who put their money in the bank. Usually this is up to $100,000. Sometimes it's more for like commercial accounts. And the goal of these is to prevent bank runs. And deposit insurance is basically works the way all other insurance does. All banks in a country will have to pay a certain amount of money into the insurer. And then if there were to be a bank failure or if there were to be a bank run, the insurance company would guarantee that people would be able to see their accounts even if the bank was insolvent. The second you'll see is government securitization of certain assets. So, after 2008, the government in the United States nationalized Fannie Mae and Freddie Mac, which basically underwrite mortgages. These are called agency mortgage-backed securities, generally like by banks or when they're being traded. And basically, what these mean is they're AAA rated, so that's like the highest rating a piece of a debt instrument can get. And it says that if this person defaults on their mortgage, the government will come in and pay it on their behalf. There has been some talk about privatizing these firms again, but it is a very contentious issue. Bill Ackman, for example, I think has advocated for privatizing Fannie Mae and Freddie Mac. Trump has talked about it a little bit. Um, but the reason it is controversial is because even if they were privatized, the risk of default on these mortgages, given how safe a security they're considered, would be so catastrophic for the global economy, as we saw in 2008, that the government would probably step in to have to bail them out anyways. So at this time, it seems to make a bit more sense to keep them nationalized. The general objectives of these policies is to limit the types of risks that banks are able to take. So you saw something like the Volcker rule as well, which prevents banks from doing what's called proprietary trading with their own funds. So like banks that take deposits, um, like Barclays, for example, could not do proprietary trading, which is like trading for its own profits with consumer money. It could trade on behalf of its clients, so it could buy and sell things that its clients wanted, but it couldn't do it for their own profits, basically. There's also the FSOC, which I can't even remember what that stands for right now. It's like the federal, let me tell you, hold on. Financial Stability Oversight Committee. There we go. Which stress tests banks to ensure that they can withstand economic shocks. There are many different, most countries have like some version of this as well because it was mandated by the Basel Accords. There's that type of oversight. And then there's also consumer protection. So in the United States, you saw the Consumer Financial Protection Bureau, which is kind of no more, which was meant to protect consumers from predatory business practices like the adjustable rate mortgages that led to the 2008 financial crisis. Most countries have their own version of this. The CFPB is kind of the most famous one. And then you'll also see that in countries that have much more stringent antitrust law, so most of Europe basically, a lot of these sort of issues will also be covered by antitrust and other like EU regulations that exist. Um, so the next thing I want to talk about is currency risk. This is a good opportunity to talk about what I think is like one of the funniest things ever, which is if you guys are familiar with the charity Greenpeace, or not really charity, like advocacy group Greenpeace, they have money obviously, and they try to invest it so they can like grow the amount of funds they have based on their donations. And there was a rogue Greenpeace employee that was in their finance department that was trading the firm's money and lost about 3.8 million euros on the foreign exchange market. And this is why risk management and regulations matter. So, pursuant to this, most firms will place limits on the amount of leverage, which is basically when you borrow money to like amplify the profits you can make on a trade, um, and risk that individual traders are permitted to take. And generally, the more senior you are, the more risk you're allowed to take on. This also applies to most different funds. So like if I was I don't know, a teacher's pension plan, I might or I was a state endowment or sovereign wealth fund and I was to hire like I don't know, BlackRock to like hire a certain amount or to manage a certain amount of money for me, I would probably place limits on different types of leverage they were allowed to use, how much risk they could take on that account. And that is, generally why these regulations exist. Fluctuations in currency exchange rates are obviously also a source of profit for many traders, but they can also be a source of risk. So, if an investor wants to do any sort of like FDI or invest in a foreign country or buy a stock from a foreign country, they might not also want to make a side bet on whether that country's currency is going to appreciate or depreciate. Like, if I wanted to buy like Volvo stock, I might not want to, make a bet on the currency that that stock was denominated in. And so because of that, investors will often hedge their currency risk by buying a forward contract that gives them a right to purchase currency at a future date at a fixed values. And these contracts also eliminate interest rate arbitrage, which will be explained in the next thing I want to talk about, which is last summer, if you guys read the news, you might have heard about this. There was a very bad day for markets once last summer. I think it was like I don't remember what day of the week it was, but in the office I was working in, there was like a bunch of people and we were all sitting around a computer with like Bloomberg open, watching the yield on treasuries just absolutely go through the roof and the prices tank, which was a scary moment, let me tell you. But anyways, as this happened last summer, there was a thing called the yen carry trade that fell apart. And I want to talk about this because I think it's a very good illustration of interest rate arbitrage. So rates in Japan before were much lower than in the United States. So investors would borrow money in Japan and then loan it out in the United States to make money. So they could borrow the money in Japan at a very low rate and then lend it to someone else in the US at a very high rate. But to make money, their currency risk was unhedged because when you have a forward contract, the way those contracts are designed is that the exchange rate that you get eliminates any possibility to make money on the exchange rate. It's relatively simple math. If you're interested in it, you can look it up. Um, but yeah, That is the simple explanation. The thing that happened was the Bank of Japan unexpectedly raised interest rates, and then their currency became more valuable, and then the trade fell apart because all these people had unhedged risk, and when they had to convert the US dollars they currently had lent out back to yen, they ended up losing money. So that is an illustration of currency risk and why people want to hedge their currency risk typically, but also in instances where they don't, it's because they can usually get carry. And that was the difference in the interest rates. The next thing we're going to talk about is the CDO market. Also, pardon me if there's any background noise. I live in a apartment building, and 2 floors above me, they are doing renovations. So if there's some background noise, sorry about that. So what are CDOs? They still exist, mostly. So CDOs are collateralized debt obligations, which basically pool together loans, mainly mortgages, and then they sell slices of these loans or called tranches to investors. Higher tranches tend to be safer, so they get paid out sooner, but the returns on them are much lower, and then lower tranches are riskier and they're paid out later, and you get higher returns. But what went wrong with CDOs? Banks bundled risky subprime mortgages, which were loans to people with poor credit, into CDOs. And then credit rating agencies gave these AAA ratings because they were diversified. So they had many, many different loan types. They had like sometimes commercial, residential. It might be like a 5-year mortgage, a 10-year mortgage, a 30-year mortgage. They came from different places, different qualities of lenders. And the idea was that because they were diversified, it was very unlikely that every single mortgage or every single loan would experience a default. But when borrowers did default, um, the value of CDOs collapsed and there were massive bank losses and then the global contagion that we talked about on the previous slide. Because many of the actual mortgages within these CDOs were not of high quality. They were of low quality because of the subprime lending that happened where people were given houses at a or given mortgages at an adjustable rate. So basically for the first 5 years, they would pay like maybe like 0.5% interest. And then at the 5-year mark, that rate, because of how poor quality of a lender they are, might have shot up to like 12, 15%, and people couldn't afford paying that anymore. So they had to sell their houses. There was a massive influx of houses on the market. This drove prices down. And then, the contagion we talked about earlier basically happened. So, yeah, this was sort of the high level overview of what went wrong. How can we apply the concepts we've discussed so far? Well, first, I think just the things we mentioned earlier with bubbles and why it's good to avoid them are obviously relevant here. There's also the hidden risk level. So complex financial engineering that happened masked real danger, where basically these were very, very complicated financial instruments. And then also something called synthetic CDOs were made. So basically, these were CDOs that were bets on whether the underlying mortgages would perform. And this very high level of complexity, coupled with the very high rating that credit agencies gave out, meant that people were generally, or many banks didn't realize how much risk they'd actually taken on. And they used many of these securities as their like low risk kind of, held very large amounts of them, thought that there was no way they'd ever default. So they ended up with much, much riskier balance sheets than they should have had. The second is moral hazard, which we also talked about. Lenders didn't care about loan quality. They passed on the risk to someone else. So the actual brokers that would sell the mortgages didn't really care the quality of the person that they were lending money to because they sold those loans off to banks to be securitized and then to be packaged into mortgage-backed securities and then collateralized debt obligations. There's also systemic risk. We talked about the contagion, and then also regulatory gaps. So the United States had long periods of very massive amounts of deregulation and weak oversight that failed to catch inflated ratings and led to just poor lending standards in general. The final thing we're going to talk about is some of the harms of innovation. The first is the harms of regulations because they are not always a good thing. And oftentimes you will see debates about like whether certain financial regulations have been good or bad. The first is stifling innovation. So when there's too much regulation, it can be hard to innovate new securities that can make people money, hedge risk, and help meet demand in the financial market. I'm just gonna put on my AirPods if you give me 1 second, because I think the construction is getting a little loud. So just bear with me. I'm hoping this is better now. Okay. So yeah, uh, a large part of this also kind of comes down to, I'd maybe use the word parsimonious, like how seamless or easy those regulations are to navigate. So Europe has done a relatively good job making sure that the same regulations apply in many different like member states of the EU. Whereas Canada, each province has its own securities regulator. So I'm from Ontario. We have the Ontario Securities Commission. And this makes financial engineering basically impossible because if you want to like create a new security in Canada and sell it, you would need to get it approved individually in every single province to go to the market. And like some might be okay with it, some might not. So regulation can certainly stifle innovation. And that can be unideal, not only because there's money that could be made that isn't, which is inefficient, obviously, but also because oftentimes financial instruments that exist and complex derivatives exist to help banks hedge risk, so to actually decrease the amount of risk they're taking on. So that's not always a desirable outcome. The second is general bureaucratic incompetence. So the state is not always good at imposing regulations. They might be ineffective, overreaching, or have unintended externalities, or be beholden to like lobbying, political concerns, etc. So that is always a concern, is how good is the state going to be at actually imposing regulations. And there's also the idea of regulatory lag, which is that if states want to approve everything before it happens, so they want to approve every single new security before it's sold or every single new exchange or marketplace, there's obviously a massive delay in when things make it to market. But simultaneously, if they act after the fact, there might be undesirable things that happen in the interim. So there are some crafty solutions around this. To my understanding, often what is done is securities regulators, if they see a bank doing something or they see a firm doing something that they think is unsavory or undesirable, they might like make an announcement being like, this thing that this bank is doing is like not allowed anymore, and we plan to like pursue litigation against them for XYZ reasons, or we plan to pursue litigation against like future banks that do this, etc. So that is something else regulators will do, is kind of make policies via the types of lawsuits that they decide to file and the way that they behave legally. There's also compliance costs. So it can be hard to adhere to securities law, and there are costs that are associated with vagueness as well. So you need to retain counsel due to the risk of a lawsuit. You also just need to spend a lot of money on like hiring compliance people and having them like audit every single thing that a person is doing, having someone to approve every single trade that an individual employee at a company makes before they make it. And overreaching or overzealous regulations can cause monopolies too, because new firms can't afford the legal and compliance fees that come associated with making it to the market, or because it's very inefficient for them to do so. Like these things can scale. If you have a very, very big company, it might be relatively cost effective for you to hire a compliance department that oversees every single department with it, every single other department. But if you're a firm of like 10 people, hiring one person to do compliance full time is obviously going to be quite a big cost on the company. So that's another concern. Um, so yes, these are generally some of the harms that you see associated with regulations, and the reasons why some of them get repealed as well. Um, I think this wraps up the slides. So what I'll do next is move on to a Q&A if anyone has any questions. Maybe what would be easiest is if people use like the raise hand function on Zoom if there's like multiple people with questions. Otherwise, just feel free to jump in. Okay, it seems maybe that we can wrap up here. Um, if yeah, I will be around at Euros and also some other like training efforts before that. So I'm sure that I will see many of you again. I'm